Good afternoon, everyone. I think we're probably just about ready to get started. This is Chris Sackett speaking. Just want to confirm that people can hopefully can hear me. I can only see a couple of people. I'm not sure what my visual thing that was going to be corrected didn't get corrected. If anybody can maybe give me a thumbs up. Michael Ott, I can see you. Give me a all right, you can hear me. Okay, good. All right, great. Thank you. So we'll go ahead and get started. And if anything's going wrong, I guess I'll need somebody to send a chat or something. There we go. Now my screen changed. Okay. Chris Sackett, I'm managing partner of Brown Winnick Law Firm. And we've got such a good slate of panelists and moderators today that I'm going to move fairly quickly. I've got just a few minutes with some logistics and things like that. So excited about today's event. You know, our second presentation of navigating seed and venture capital during a pandemic. The good news is it's our second one. The bad news is it's our second one called during a pandemic. Not ideal, but we had a great success the first time. I think we've got over 60 participants today, so we're excited about that. We've got some good content. I'd like to start by thanking our co-sponsors. Along with Brown Winnick, we've got the Greater Des Moines Partnership and LWBJ. Our three organizations have been kind of shoulder to shoulder, side by side in this space for a long time, and we value our relationship with both the partnership and with LWBJ and the individuals and players at those organizations. So again, thanking those folks. I'd also like to especially thank at our respective organizations, Allison Flaherty at LWBJ, Courtney Shaw at the partnership, and Ryan Bratvold at Brown Winnick. Those are three folks in all of our kind of BD and marketing areas, and they've done a great job, a lot of hard work to make this easy for the rest of us. So thank you to them. I'd also like to thank, in my notes, I kind of wrote, and I'd like to really thank a person who's a very close and dear friend to me, Mike Caldwell. Mike has, again, not just, I would say shoulder to shoulder with us, but he's really been ahead of us and leading us, all of us in this area for a long time. As I said, he's a very close friend of mine and has been a great leader to us in this industry. And I want to thank Mike for this event, for similar events, for all the successful startups and successful investors and investor groups in our marketplace that without Mike Caldwell's leadership, that couldn't have happened. So thank you very much to Mike Caldwell. Moving on from that to the more boring stuff, the logistics, we're going to have two great panels today, an investor panel and an entrepreneur panel. We're going to have a 5-minute break in between those. Those are about 50-minute sessions. We'll have about a 5-minute break in between, give or take. And we will not have live mics for others besides the participants. And so if you have questions, thoughts, whatever, you'll need to use the Q&A or the chat function on Zoom to get those questions submitted or your thoughts to folks. We are recording this, and that will be available after the event. I went back and watched some of what we did previously, and it really it resonates now just like it did then, and some things have changed. So it's very timely to have us proceed today. Moving on to the agenda slide. So I'm going to make a few opening remarks and a couple of observations that I have about where we are in the current state on capital raise. Then we'll turn it over to JD Geneser with LWBJ to moderate the investor panel. Then we'll take a small break and we'll turn it over to Brad Dwyer with Roboflow to moderate the entrepreneurial panel, and then a couple of closing remarks, and we'll be done for the day. With that, I'm going to tell you just a little bit about Brown Winnick. We have a slide. I'll probably, not cover the slide directly. What I'll tell you about Brown Winnick is we are about a 70-attorney, business-oriented law firm. So our business clients and our business approach drives everything we do. A lot of what we do that's relevant to this group is we do a lot of work in the early stage capitalization, venture capital, private equity, and the companies who receive that capital the advisors that advise companies or investors in that space. We spend a lot of time there. I spend a lot of time there. So I've got a lot of folks on this event who I work with extensively, I have great respect for. It's a dynamic space. We enjoy working in it very much. Excuse me. Brown Winnick also does all the other things that business law firms do. So if you're in this space, you tend to practice securities law, you tend to practice mergers and acquisitions law, intellectual property becomes very relevant, and we do all the other stuff that you see on the slide here. So Brown Winnick is excited to be part of this event and part of this industry and this space. And so we're proud of that and glad to be participating today. The only thing that I've got sort of left at this point then is to make just a couple of quick observations, because I kind of feel like the panelists are so great and the moderators are so great that I'm kind of like the guy right before happy hour or drinks. So I just had a couple of observations as I thought about where we are now, still in a pandemic, but compared to where we were the first time we did this event. You know, what I would say is we are still in a global pandemic, but we're no longer in a panic with respect to capital raise. At the front end of this, one of the questions was going to be, what's going to happen to what a lot of us call our playbook, right? There's kind of a way in this world that these transactions or these companies sort of play out. And the playbook has been modified, but not thrown out. And so to the extent, a year ago, we were all worried that things would come to a screeching halt and we wouldn't know how to do deals. That's not the case at all. So we've got a new playbook and we're working our way through that. Some things are better, some things are worse, some things are just different. But the new playbook has been adopted by a lot of people. The second thing I would say as an observation is seed, venture, private equity, angel, all of those sources of funds are still flowing. And I would say flowing at a very brisk pace. There was a bit of a pause, but a very short pause when we kind of entered into this pandemic. But I have seen no slowdown at all, at least in the companies and investors that I work with, maybe even an acceleration, because once people figured out how to do so many things remotely, it really opened up the floodgates. And so the funding is flowing at a brisk pace. Along with that, I would say this has opened up more sources and maybe more geographies of capital. So I am seeing more funds at all stages, particularly in venture, private equity, and strategic transactions than what we had seen before the pandemic. So I think that is a positive of not of the pandemic, but of remote capabilities, video conferencing, and people becoming comfortable in doing things like pitching, conducting due diligence, recruiting key employees. All of those things have become, in some ways, more efficient and effective and more global. Kind of goes hand in hand with that. What initially slowed capitalization deals down, in my opinion, is now at least they're at least maintaining the pace they used to have. And I would say really some of them have sped up. The people that are most tech savvy are moving at a very brisk pace and can move deals along at a faster pace. And the last observation I would have before I turn it over to JD is, because of all these things I just mentioned, it's a difficult time in the world, but it's a good time to be an early stage investor or a startup or growth stage company in Central Iowa or in the state of Iowa, because of all these things that have really started to work quite well. So with that, I'm going to move out of the way and turn it over to my friend and co-presenter, I guess, JD Genieser, who's going to lead our investor panel.
Thank you, Chris. Can everybody hear me okay? Good, okay. Maybe, I don't know who's got the slides, maybe Mike, flip it to our LWBJ slide. I'll give you a little introduction on us. Like Chris, we're about a 60-member CPA firm, audit, tax compliance, tax consulting. And then our capital advisors arena is a lot of focus on investment banking, consulting, outsourced CFO related services. Had the opportunity, obviously, to work with many on the panel and many participants here today, and helping them run through a capitalization process or an M&A process. We do a lot of diligence, we do a lot of valuation services, and then we spend a great deal of time working with companies raising capital. Like Chris, you know, we're proud to be associated with this with Brown Winnick and the partnership. I echo Chris's comments with regard to Mike. None of us would be here without Mike Caldwell and the ecosystem that he helped develop over these years. So we're very appreciative of that. You know, we're a unique CPA firm. We're nimble, we're entrepreneurially focused, and we really enjoy the opportunity to participate in these types of things, but actually work with emerging businesses. We're going to run through an investor panel today, and I'm really appreciative of those participants. If we could flip the slide. You know, we actually have a really diverse and great group with Eric Engelman, and I'm going to allow them all to introduce themselves. Craig Ibsen, Joe Leo from the legal side. Joe and I work a lot of deals together, and then another partner of mine, Sheldon Ohringer, who is a member of Mango Seed with me, but also just an individual investor, entrepreneur, and has built and sold companies as well. So we're going to allow them to introduce themselves. What we're going to do is I've got a few questions that I'm going to run through just to kind of spark the conversation. We will then allow for additional questions from the panel to come through and the participants to come through, and then, you know, do a little wrap up on the back side of it. To Chris's comments, I think it's very fair to say that, you know, while there was a little bit of pause, we've certainly seen a lot of activity in the capitalization space. We've closed 2 deals from a capitalization perspective with never meeting the investor. And so technology is a wonderful thing. And we're going to get into some of those components of how deals are getting done. And, you know, one observation I've found is initial meetings, initial conversations, what used to be a conference call is immediately a Zoom call. And those relationships might be formed that may have never been formed because you're looking people in the eye that maybe you would have never had the opportunity to do so. So that being said, I've got a great panel, and I'm going to kind of hand it over to them a little bit here. We'll begin with Sheldon, and then move forward. If you just give a quick introduction, a little bit about your background from the investment perspective, and we'll take it from there.
Thank you, JD. It's a pleasure to be on this panel, be asked. I know it shows Mango Seed. That's a small group of individuals like JD and others where we pool money together. In addition to that, I'm part of Formation Partners, which is just a small business advisory firm. Most people probably don't know my background, but my background really is a business person, where I led acquisitions for 3 public companies. I took a company public with about 1,000 employees, and I think that led me to having the capital to make a bunch of private investments. And today, through a series of different vehicles, I have about 100, though I'm mainly passive, about 100 personal investments.
Thanks, Sheldon. Eric?
I'm Eric Engelman with ISA Ventures out of Cedar Rapids, former founder of a software company, founder of a nonprofit startup ecosystem building organization. Our fund is the brand spanking new one that was founded in the middle of a pandemic, which I don't generally recommend doing, but excited to be here today. Between our prior fund and this fund, we've got about 60 investments into companies, most of them in Iowa companies.
Go ahead, Craig.
My name is Craig Gibson. I'm the managing partner of a venture capital firm here in Des Moines, Iowa, called Next Level Ventures. And we started investing out of our first fund back in 2014. We now have kicked off our 3rd fund recently. Like Eric, in the middle of a pandemic, we just launched a $150 million national fund focused on fintechs. And as Eric would attest to, it was kind of unique fundraising through a pandemic. I wasn't sure how it was gonna go, and it turned out to be an extremely time efficient process. You know, I met 60, 70 different odd people. And back in the day, that would have required, a week's worth of travel to meet 3 people. And instead today, I was able to meet 3 people in a day. So I look forward to meeting all those people individually someday, because now they're just 2-dimensional tiles like all of you. So I look forward to, Chris, I hope this is the last time we do this virtually. I remember watching you and JD at the same locations a year ago, and what a lot has changed in a year. And so let's hope it's the second and last time, and next time we'll do this face to face.
Amen.
Amen.
So Joe Leo with Brown Winnick. My involvement is with a lot of the startups that come through some of these investment pitching groups and those kinds of things. I do about half my time with early stage companies and technology companies, and then the other half I represent 5 public companies, and so I do securities compliance, capital raises, and those kind of things, and hopefully bring as practical of advice as I can, which I think helps me to sort of navigate with early stage companies.
Thanks, Joe. We kind of dusted off, to Craig's point, we covered this off a little less than a year ago and kind of addressed some of these questions. We've kind of revamped some of the questions, but want to kick off a little bit more pandemic focused, and really some of the impact from the investment and portfolio perspective. So the first question for the panel, and we might start the opposite way a little bit, maybe begin with Craig and then Joe or something, but from a portfolio perspective, how has it impacted either initially and then throughout your existing portfolio of investments, and those companies that you had already made a commitment to?
I'll start, and I in preparing for this, I kind of counted up as I was supposed to, how many investments we made since this call last time, and I was shocked. We invested in 11 companies in the last 12 months, and to give you context, we've been around for a while. Our second busiest year was 2019, and we did 4. So we've been prolifically busy, but it's kind of been a bit of a roller coaster, because I do remember I was sitting in the same chair as all of you were last year at the same time, and we just had closed an investment. I was just so grateful because I thought the wheels were coming off the world, and we kind of launched into March. And at that point, I thought, conserve all capital, batten down the hatches. And I had no idea where we were going. And out of that, coming into the spring, a new normal emerged. And as Chris said, it's been busy. We've done more deals than I could have ever contemplated. Yes, we're starting to do earlier deals. That's part of it. But I would probably say we're going to close another 3 investments in 60 days. So extremely busy, surprisingly so. Would have never contemplated that. And another point that Chris mentions, it's never been a better time to seek capital, found a business in Iowa or anywhere else, because what the pandemic's taught us is, anybody can connect on a high quality interaction with anyone, investor to entrepreneur, anywhere in the country today. So the barriers have fallen, and it's been a very, very busy year for us, and it'll continue.
Craig, did a little bit of focus have to go to their portfolio as well, and were some industries impacted more than others?
What things that are focused on consumer were a little more focused, yes, but by and large, no. We've had businesses that have benefited from the pandemic, and that's obviously the case. But aside from a couple, it's been good.
Good. Eric, what about you said you guys have been involved in about 60 investments. You've done some now through ISA as well. with regard to the impact of your portfolio companies and kind of your focus there versus maybe the opportunity of new deal flow.
Yeah, I don't have a whole lot of, maybe the timeline is a little bit different in our case because we're pretty new in the new fund anyway. But it feels incredibly busy. Yeah, the wave of companies to look at is exciting. So I think similar to Craig's point, it seems to be a good time. But some of the things that I noticed about the portfolio companies we'd invested in previously that, a lot of them were not as badly affected as I expected. We have a sort of internal Slack channel thing. And I remember mentioning, okay, guys, the shit's hitting the fan. The world's on fire. If you want to talk, like, just call me. Like, let's just talk if you need somebody to talk to, because this is really weird. And I've never seen this before either. Nobody expected a black swan sort of event like a year ago. So some of it's just been, reaching out to founders to make sure that they have someone to talk to about it, which is part of my job, I guess. But I think most of them, though, they reacted very quickly and honestly took advantage of the situation. I don't have a single one that I can point to where it's like COVID killed this business. If it was in trouble, it was probably already in trouble. It's more of a one where they found an opportunity in it and really took advantage of it. I've been actually pretty impressed at the resilience of our founders and what they've been able to do given the oddity of the last 12 months.
It is amazing. We've seen the same thing with regard to a lot of our clients. Sheldon, with regard to you have 100 investments, just kind of an overview of how it might have impacted some of those investments and maybe your focus as well.
Yeah. And again, just to be clear, somebody's already asked me in chat, that's a lot of investments. 90 plus are currently on angel list. So I want to make sure people realize that these are passive investments. Though every entrepreneur wants help, sales, money, overall, these are passive investments. I do have a few that I can think of where I'm in close contact with the entrepreneur. I think my general comment would be, if you were pre-revenue and you were looking for that next round, and that was March, April, May, you might have had a difficult time. It depends who your investors were. It depends what signs you were making, especially as a pre-revenue company. But obviously, we all know what's happened over the last year, and I haven't heard of very many companies that I'm aware of, that I have any close contact with, that didn't survive. I think the only comment I would make is it's who your investor is. I think as an entrepreneur, if there's entrepreneurs on this call, who's your investor? Who's been your investor? Who's your future investors? And see what they've done with this round. And that might be a good gauge on who you would pick, in a subsequent round.
That's a good comment. Joe, how about you with regard to your clients that might have taken on capital, the early stage businesses, with regard to the impact and their focus?
I kind of saw two things. I would say right when it hit, we sort of started addressing a bewildering number of questions that nobody had really thought about or addressed. And some of those were legal and some of them were business. Some of them were, obviously the biggest risk I think some of these companies had is losing talent because of uncertainty in the market, that they have family members they need to take care of, kids, those kind of things. And what does that mean? What's the requirements? And I think that we moved through that pretty quickly. And then, I saw a lot of my clients, I think, use their resources a lot more effectively than they had in the past. And it seemed to, I think we had a successful year, and I've personally never been busier. And a lot of it's been good things. I'd echo what everyone else said, is that most of my clients kind of weathered it pretty well. And really, I think that they started, like Craig pointed out, started using technology in a way to maximize the time that they spend, reached out to investors outside of the market. And I honestly think that we sort of positioned ourselves to be better going forward, because I do think that has made a big difference.
That's good. Yeah, we got a very optimistic panel. That's fantastic, and I think we're seeing the same thing at LWBJ. One of the follow-up questions I have is really more pandemic related as well, and we'll move on to some other futuristic conversations. But I assume this may not be the case, but have any of you had to, and particularly more you, Craig, probably, and Eric to some degree, and Sheldon, had to reserve any capital that might have been into new deals for your existing portfolio companies, or had to refocus more attention on those?
We we have a lot of capital in reserve just because of the size of investment pool we manage today. And, you know, as you can tell, it's growing. So, you know, that's just part of how we allocate capital. You know, as I mentioned, we've started to go earlier. We've started to do some pre-revenue things, which is a new theme for us. And when we do that, and you manage, you know, today close to $200 million, you're doing that. You know, if you're going to write a small $100,000 check, you're doing it with the expectation that you're going to continue to participate over the life of the company and in future capital raises. So that's always part of what we're doing. And certainly as we're able to layer on other funds, you know, as long as a company is performing and you know, optimistic about their future, you know, we've got enough capital to be there for them, which is a lot different than, you know, people that are angel investors who are frankly writing out of their own balance sheet. You know, it's a different calculus that they may go through, where, you know, every day we wake up trying to write checks. That is our job, and that's what we're paid to do.
Sheldon or Eric, any comments there with regard to reserve of capital?
We didn't change our approach or math policy at all on that. Our fund is kind of young, so I don't know if it would have mattered anyway. But what did change was how fast we had to all get up to speed on PPP and EIDL and different SBA loans and the different ways to kind of work those ways to handle cash shortfalls. There was already a thing that I think we were kind of interested in, you know, augmenting with debt in an intelligent way. But certainly when the government's effectively backstopping businesses and in some cases forgiving it, it's certainly worth, you know, startup founders considering, and we had to get up to speed quickly on that stuff.
Yeah, my only comment would be, it seemed like I wanted to know from many of the entrepreneurs who I had a close contact with, what the status was. You know, where were they at financially? Because a lot of people say they're at one spot and they want to raise money, but they still had money for 6 months or 9 months. And the ones that, you know, many companies certainly reduce their expenses. They reduced, you know, they didn't hire people they didn't need to hire. They reduced, obviously travel went away and other types of maybe business expenses. But I don't remember writing any checks, any emergency checks in March, April, or May at this point.
That's good. Craig, I'm going to come back to you real quick because you made a comment. Your original charter was focused on companies of $1 million in revenue. You've said a couple times now pre-revenue. What can you give us an update? Is that the second fund? Is something changed that you're investing in the pre-revenue companies?
It's a great question. We ran out of companies that were $1 million or more in revenue, JD. So
was that a softball for you there?
Necessity is the mother of invention here. And so, you know, when we came on the scene, you know, in 2014, there was a lot of interesting companies that were just there. You know, Dwyer was one of them, for example. And so it was kind of easy to step into things that had been in the ecosystem that all of you are aware of, that have been part of the ecosystem for another number of years, like Mike. You know, we're just kind of waiting. And after we invested in most of them that would have us, you know, we needed to kind of go early to help grow tomorrow's $1 million companies. And so that was really just a necessity. And that's part of how we did 11 deals, you know, over the last 12 months. And I don't see that slowing down. I think we'll do 11 more, and that'll necessitate more than half of those, JD, will be probably pre-revenue companies.
Great. Good news, breaking news here.
And glad to have Eric on the scene, because, you know, we've done at least one that I know of, and probably another one, and maybe even three if I can't keep them straight anymore. So it's great to have another early stage investor over in the other half of the state to collaborate with. So it's great for the ecosystem.
No, I actually think that's a great point, and we're very glad to see Eric get ISA Ventures going, and very anxious to see everybody collaborate there as well. And Eric and I have had a chance to connect a little bit more on that as well. And that's you know, again, congratulations, Eric. So with regard to outlook for this year and what's going on right now, you talked about deal flow looking good. with regard to the quality of investment opportunities, do you have any observations with regard to the readiness, with regard to the companies, the entrepreneurs, the founders? Are you seeing anything different from a perspective of the pitches you're seeing and the opportunities you're seeing, and maybe the uniqueness of the ideas? And I just want to go across the whole panel here. Maybe Joe, begin with you. Even you see a lot of different companies that come to you initially from a perspective of, hey, wanting to raise some capital and everything. Are you seeing a kind of a different generation of ideas coming?
I think that the deal flow has been really good. I was sitting on a pitching review yesterday for Iowa Biotech, and the groups that they had come through last year, one of which I know Craig invested in, that did very well, light years ahead of what they were getting a couple of years ago. So I think the deal flow is better. I think I grew up in Wisconsin, so I don't have a dog in the fight, but I'll tell you that Iowa State, I think, has done a great job of rolling some of their businesses out. And those are more developed than they've been in the past. I think that, to jump on the group who've thanked Mike for all that he's done, I think that that's a lot of that is at his doorstep, is that we have a more educated group of startups and people who are getting involved, who have done the research, who kind of understand what it takes and have self-selected into that. So I've been seeing a lot of good deal flow, and I've been seeing a lot of companies that really know what they're doing. Like I said, it seems to me that we're, 2021 is going to be another good and busy year. I don't see it slowing down at all.
Eric or Craig, you want to take a shot are you seeing any, with regard to the readiness of the companies, even though Craig they may be pre-revenue, with regard to just, maybe a little bit more ready and prepared to take on capital?
I think so. Yeah. We've over the last 5 years, right? You've got the University of Iowa's Venture School program, the proliferation of accelerators around the state, the open and free knowledge about startup culture that would have been a lot harder to get 5 to 10 years ago. I think it helps people get acquainted really quickly with what's out there, and how to be a better founder, and how to avoid dumb mistakes, at least hopefully. In our case, we've got an accelerator program that hopefully progresses nicely with companies as they grow, to attempt to help them the same way. But I think the real difference is it feels like there are more examples of successful companies now than there was 10 years ago to point to. Recent exits in Iowa City come to mind as an example. And there's a bunch of just really amazing things. And those people are giving back to the community and sharing their knowledge, which makes everybody slightly smarter than they were before, which is just amazing.
Yeah. I'd echo that. I think people are better prepared. So we're seeing smarter founders who are well prepared, and credit to the vast ecosystem, and a lot of them have worked with LWBJ, Brown Winnick. So there's an advisor group here that has continued to evolve and get better, that's helped, people that are open to feedback, because that's not every founder. The feedback's there, and you're right. Joe mentioned the Iowa State. We were part of helping create the Ag Startup Engine, so we're an investor there since the beginning. And that was just a little idea of helping ag entrepreneurs with Iowa State roots. And who would have thought? We've had 3 successful exits in 3 years. It was, probably on an ROI basis, one of the most successful seed investment pools that exist. And I thought we'd, give away every dollar we gave to them. It was kind of philanthropic. And, out of that, we've led a deal recently and partnered with Eric on. And, it was involving some stuff that was frankly over our head, but we pulled in a lot of smart, investors and strategic people, and we're happy to structure it. And, great example, we put together the whole deal and said, please don't put us on the board. You got smarter people in the room, and, send us a quarterly update. And that's a new model for us. So if we could, if that's how we can be helpful, we're happy to be helpful in that way.
Sheldon, any comments?
I mean, I think a lot's been said. I mean, I think what everybody's saying is there is now an ecosystem. As I moved back from Colorado 15 years ago, and I think I remember talking to JD and one of his partners and talking to some other people in the community, why don't we have an angel group? Why don't we seem to have what other communities have and some level of association with universities to get out technology? You know, why don't we have an ecosystem? And it's clear to see, clear to say, obviously the people on this call, there is an existing ecosystem, and it's probably just at the beginning. You know, it's probably just going to continue to grow and blossom, because with every successful exit, then there's more new investors and people that have confidence in taking their ideas to the startup stage.
Yeah, that's a good comment. And founders out there that have already done it again now and they're coming back, right, too, which is very, very important as well. So we've got a limited time, but I'm gonna kind of move into now the process of the you know, maybe some of the participants that are getting ready to raise some capital or in that process, et cetera. With regard to like the diligence process today, you know, I'd like to even, you know, I want all of you to chime in a little bit with regard to, one, if there's been any changes in the diligence process. We obviously talked about, you know, the remote and the Zooms and all of that kind of stuff. But with regard to the normal diligence process, it used to be maybe a lot of face-to-face, maybe office visits, all of that kind of stuff. Do you guys have any perspective or anything with regard to how you are currently running diligence that might be different, or even any input of kind of your current diligence process for the participants to kind of maybe get an update from? I'll throw it out to either one of you.
When I looked at how many deals we did, you know, and I'm in the office, and all of the people that work with me are in today, but we've had one in-person meeting in the year since we've talked on this panel. So our conference room is dark, and but being in Iowa, we're all 1 degree removed. So every one of those 11 companies, we had known every one of them. We've had in-person meetings before the pandemic descends upon us, with one exception. And so I thought a year ago, I'm never going to make an investment in somebody we haven't, you know, met face to face and shaken hands. I still almost haven't done that, but I know, you know, I believe the pandemic is, you know, we're in the dog days, and as we get into summer, it'll be a lot different. But as I invest nationally now, I know that's the new normal, and I am busy now having meetings across coast to coast. I think we'll probably make our first investment out of this new fund, and it won't be an Iowa company. So all 11 companies I've talked about have Iowa roots. So it makes it very easy for us to even in the pandemic have that intimate connection. But I'm moving in the direction that, you know, even without the pandemic, we'll be making investments in companies where we're never going to have met the founders. And that's, to your question, a different due diligence process that I did not think a year ago, nor did many people think possible. And it is the new normal, and that genie's not going to go into the bottle. So I think it's going to affect how we staff. I thought, you know, I needed an office or presence in the East and West Coast. Do I really need that? Because maybe we just can continue to staff and manage $200 million from Des Moines, Iowa, and we don't need anybody anywhere else. You know, the due diligence is the same. You know, what we look for hasn't changed. Data rooms haven't changed. Timetable to close hasn't changed. I think it's just the frictionless of money and how easy it is going to be to put together a deal with someone you haven't met before. That has changed, and it's not going back.
Yeah.
I don't think I have anything to add to that.
Yeah, that's good. Joe, with regard to your side of it, have you seen anything different?
You know, I think that people are, I think that they're getting more comfortable with the tools. You know, I hate to make it so black and white and sort of simplistic as that, but you know, I had 2 meetings with new companies this week that that we were interviewing with, and Both of them sent me links to data rooms that they'd already set up beforehand that had their documents together. And I will tell you that that is atypical. If we had done this before, I don't think anyone would have had that ready. And I think that that's the one difference, is that people are anticipating that there's not going to be a personal meeting. And so they have to get ready in a different way. And I think it does kind of grease the skids a little bit and make those work better. I think people are also being a little more creative as far as who they're reaching out to. And it's making it easier for them to maybe approach investors and engage in some level of diligence that are outside of their market that they might not otherwise have access to. And so I think that there is some people have sort of expanded their views and realized that that maybe the idea of only approaching people that they can drive to is not true anymore. And quite honestly, for me at least, as well, as we've been incredibly busy, but I'm spending less time out of the office. And I think that there's a benefit to that. Obviously, for me, it's not as much fun as meeting people face to face, but I do think that there is a renewed focus on some of those kind of blocking and tackling things that I think are easier when everyone just is in their office and connecting electronically.
I want to add one more point here, and there's folks here that are connecting that are interested in raising capital. So please, shoot questions to us in the chat as they come up. But there's, we said it on the outset, it's never been a better time to raise capital, and you've heard that in prior years, but really it's true. Back to what Joe says, all we have to do right now, all I do is work. Our social lives are upended. There is no more drive to the office for most people. There's no more flights to, a fintech convention. And so all people are doing is knocking out meetings and working. So we have a situation where balance sheets are full. There's a lot of capital looking to find a home. And you have a lot of people that are more accessible than they ever have been, just because of the constraints on their lives the pandemic has brought. So take advantage of that. The old school way of, find a warm introduction still holds sway. So if you're trying to meet someone and you don't know them directly, but can find somebody on LinkedIn or in your network that does know them, you're more likely to get a meeting. But if all else fails, hit a cold LinkedIn intro, hit a cold email, because all of us, all we do is work, and hopefully that's going to change this spring, but that hasn't changed so far. Reach out. We have checks to write.
Well, great. We're kind of running up against a little bit of time. I do want to address kind of one other topic with regard to terms, valuation, structure, anything that's evolved that you're starting to see a lot of. Craig, we teed one up for you this week, which is very unique terms. Is anybody seeing anything different with regard to talking about SAFE, we talk about convertible notes, et cetera, but kind of what are you seeing out in the marketplace really now for kind of the participants listening in with regard to, structure, valuation, and any types of terms that might have changed or just even trending right now?
I saw 2 times in 1 week, which is, I don't usually get to see new structures, and especially not twice in 1 week, but I spoke to a firm in Minnesota that was offering, it was essentially mezzanine debt that was paid back through a portion of revenue with some equity-like features. And I literally saw it twice in 1 week, and I'd never seen it before. And so I don't know if that's just a chance, but I do see people being a little more creative on what they're doing, especially to kind of focus on the companies they're investing in. So I don't know if others have seen that, some different structures, but I do think that I'm seeing a little more creativity than I have in the past.
I haven't really seen anything meaningfully different. I think when we, see NVCA publish, their documents, we're not going to see significant changes in what's going on. Other than valuation, I think valuations have just inched upward. But my advice there, the fundamentally most important thing is, if you're in the middle of a capital raise or beginning, make sure you've got the right advisors in your corner so you don't make a mistake early that can cause you to screw up your capital stack, or which makes it harder for the next investor to go, what the hell did you do and why did you do that, and unwinding that. So the market's good, but make sure you've got, if you're unfamiliar with raising capital, make sure you've got the right people advising you as you go in the process.
To Joe's point, we did one investment that was a revenue buyback sort of model so far. And it's interesting because paired with the accelerator program, the earliest stage one, when we're not even sure sort of where they're going to be when they're done, what type of company it is, the ability to use those kinds of terms and maybe to normalize that to be something that's a model that can be used in certain situations is just really exciting. It seems like there's going to be a lot of innovation in certain classes of investment that just could be done differently. It's exciting to watch.
Yeah, we have a client right now that had received a term sheet really based upon, it was really more of a convertible note, but it was really more based upon a revenue buyback as well, 5% of gross receipts beginning after 30 months. And it's a unique structure, but it was an industry player that kind of understood the company as well. And when you think about the payback on a 5X, it's something to kind of stomach a little bit, but it's also a non-dilutive investment opportunity for them if they really believe in their growth. We have a few questions with regard to, I'm going to just kind of pop around here. Does anyone on the panel have familiarity or strong opinion on what's called up the ladder warrants? No comments.
I've not heard that term before. I'll tell you that as I give this advice a lot, unless you sit down and do the math, warrants are not free if you can give them, even though, as with anything, it's always dangerous having your attorney do a spreadsheet for you. But I do think that any kind of instrument that you have to be able to model it out. Otherwise, you're sort of negotiating without any kind of bearing. So I've not heard that term. Maybe whoever asked can give us a little detail on what that entails.
And then Lana asked with regard to, and I actually just heard this last week with regard to anybody who participated in Clubhouse. I'm not sure if that's a crowdfunding site or not, but I believe it might be.
The audio social media channel, yet another social media channel that we're all very excited to have to think about. Excited to participate in Friday. Ben McDougall's kind of set up a group on Friday morning to talk about this, and excited to use another channel to meet with people and make some good connections.
And then Ben actually asked with regard to, which is a great question, Ben. Thanks for the great discussion when it comes to attracting more financial, capital VC into the state of Iowa, with regard to how can we introduce new angel VC investors into Iowa. And I'll chime in a little bit. It's with, the development of Eric and Craig's fund and all of that. They start that process of investing or co-investing and seeing that whole opportunity and really starting that process of saying, hey, there are professional investors in this state that have looked at deals. Maybe someone else has some ideas as well, but it sure seems like more and more investors are, the old term that we were the flyover state, I don't think necessarily holds true today, but maybe you guys can chime in a little bit about how we continue to drive more VCs and investors into the state.
There's a Midwest Angel event that I think is coming up here that was pre-pandemic. The last one was in Des Moines at the new Hilton. So it's going to be virtually this year. will be attending, but you'll see at that event, which is a great watering hole, and I think it's $50 or maybe free for founders to attend. You know, you can reach out to me if you would like. I'll put you into touch with the details, but it's a great place to connect with regional angel investors, look at who's attending that. And, you know, they're going to it virtually because they're looking for great Midwestern companies. And, you know, last time they had that event, it was here in Des Moines, Iowa, and some of the folks here sponsored it and were part of that. And it's in the chat.
Yeah, that's a good point. I have one more question for the panel, particularly the investors, and then we'll try to get the rest of them. I know we're up against the time a little bit, but you know, what are the key factors that you're looking for in a company seeking investment?
Team, market, customers, and products never changes.
Team, market, customers, and product.
That's right.
It's a pretty fair summary. To put a little more detail on it, I feel like one of the things we really look for is the ability for the founder to drive consistent progress over time. Lines, not dots, so to speak, and just seeing founders be able to move and then move the goalpost a little more and make more progress and move a little more is a really key thing for us. I think the other is you know, really a market that in our case that we understand or that we think we can add some unique value to. It's got to be an industry where I can text 10 people in an hour and get some feedback on an idea. If I can't do that, it's probably not going to fit for us. But to Craig's point, in a lot of places, it really is pretty simple. I think that team is always number one.
This Sheldon, I'll make a comment about the previous question. It's just success breeds success. The more success the entrepreneurs have through exits, the more entrepreneurs that they can fund in the future. And I don't think there's anything, I agree with Eric, anything more important than the team. Teams can overcome a lot. There needs to be a good idea. There needs to be a problem that has to be solved. And again, I'm more of an investor, something that's post-revenue, but seeing revenue before it happens, that takes a good investor. So I would make sure if you're an entrepreneur, you're picking the right investors, the right agents, whether it's capital raising or legal, that have been there before, because it takes a keen eye to be able to help people that don't have any revenue.
Are you guys seeing any specific industries really emerge? I mean, it's certainly telehealth and all of that, but are there other industries that you've seen really emerge over the last year?
I feel like it'd be hard not to point to education and the way technology is changing the way education is delivered and considered, both higher education and K-12 for sure. And I feel like the proliferation of technology in the ag space is just going to continue to change that industry as well. It's everywhere. Healthcare, it's everywhere. Yeah, I feel like the technology is just going to upend pretty much every industry. And maybe I listed sort of the big ones. Maybe it's the sort of narrower niche ones where it's going to be, you know, real estate investing or something like that, where there's a really niche plays that technology can just change the whole paradigm. It's an exciting time.
I think I'll echo that ag plank. If I think of one sector in Iowa where we play to our strengths, that's the area where more out-of-state capital is flowing into this state, chasing opportunities. So shout out to Kyle and Casey, who are right in front of me on the tiles.
Yeah.
So it's a great place. Iowa's a great place to start an ag-related venture. We got a lot of mentors and resources and strategic partners, and that trend is going to continue, and we'll play from strength to strength, in addition to a lot of other areas. But I think that one is going to continue to shine.
Yeah, I would agree with that.
And Michael, see you there.
Michael too.
Michael.
Yeah, to that point, we do have a fantastic founder panel coming up here pretty quick. I think we have one more question with regard to, or a few more questions. I apologize if we don't get to all of them. How important is early stage non-dilutive funding, SBR, STTR, prior to one of your own investments? You know, I'll chime in a little bit. Obviously, non-dilutive capital is very important. A lot of times, what that gets you to is some type of validation or, you know, inflection of you know, value that allows you to maybe get that traction that when you go out to investors, makes that process a lot easier. I don't know if anybody else has any comments.
You know, and only in kind of areas that SBI are as attractive, is that even possible? With the exception of the rare free money dropping from the sky and PPP money, which I think will hopefully end, unless we're in an area of life science, and which we are. We do everything in Iowa. That's just not available, and it's great when you can get it, absolutely, but it's just not something you can count on to run your business.
Well, go ahead, Eric.
No, this is Joe. I think it can help. I can also tell you I've seen it prop up companies that were going the wrong way for a while, and I think the other danger of it, I'm a part-time law school professor, so I feel like I can denigrate professors without feeling too bad, is that I do think it's helpful so long as people look at it the same way that they do for other programs. But I also have to always remind my clients that your investors are not like the grant funds that you've gotten. And so there is always kind of a reminder that goes along with that, especially companies that are used to getting grant funding, is we can't pitch the two the same way, and make sure that you understand the motivations being different. So those are the double-edged swords that I see sometimes with the grant funds.
Yeah, that's a good point. Well, I think what we'll do, we're right about at time. I thank you guys. Great resources, as Craig said and Eric said. Reach out to them. They're looking for quality deals and looking for opportunities. There's a lot going on. It's very interesting because the resiliency with regard through the last 12 months has really been outstanding for the state of Iowa, and there's certainly deals getting done. We've seen several deals closed with our client base, and so like Craig said, most deals he's closed in the last 12 months. So there's certainly opportunities out there, and I think the next panel from the founders perspective is going to be obviously very, very, very interesting and very informative. So I think we'll take maybe a 10-minute break. And then Brad Dwyer is going to moderate a panel of the founders, and we'll kick it back off. And apologize if we didn't get to all the questions, but we appreciate everybody. And panel, thank you very much.
Well, we'll get going with our next panel then. Our next panel is an entrepreneurial panel. So this is the folks that are really in the trenches, not just writing checks, but seeking checks. And in the case of these folks, receiving checks, and probably more importantly, but using those checks to execute on their business plans. So these are it's a great panel, and actually a great moderator too. So we've got Brad Dwyer from Roboflow and previously Hatchlings. Brad's had great success as an entrepreneur. Also, I happen to know Brad makes investments, so he understands both sides of the equation, if you will. So without further ado, I'm going to turn it over to Brad and the wonderful panel we've got.
Thanks, Chris. So as Chris mentioned, I'm Brad, and I'm one of the co-founders of Roboflow. And we build developer tools that help any company essentially take in image data and turn that into useful information. So that's everything from helping pharmacists count pills more effectively, to helping oil companies detect leaks in their pipeline, all the way to helping students build an app that can tell you what's in a sushi roll. Really excited to get started on this panel. I think maybe if we could start out by having each one of the panelists give a short sort of 30-second overview of your company and what you're working on, and a bit of information about how many fundraising rounds you've had so far and the type of investor and that kind of thing. So maybe if we could start with Lana.
Sure. Hey everyone, good afternoon. So the company that I run is called ClinicNote. It's a health tech company. It's an electronic medical record, so electronic documentation for therapists. Initially, we thought it was going to be just private practice speech therapists, but now we service university clinics and private practice clinics across all different therapy disciplines. And we have we've raised $300,000 so far and are in the midst of raising another 300. What was the other part of that? From who? So We have been a part of the Global Insurance Accelerator. We have some angel investment, and then we also are currently working with the new ISA Ventures company here that just started.
Great. Maybe Kyle could go next.
Yeah, sure. Thanks, Brad. Kyle McMahon, the founder of Tractor Zoom. We are a search engine for heavy machinery auctions. We collect all that in market data and transaction data and transparently help people understand what it's worth. Think of it as a database of market trends. And I founded the company in late 2017. We've raised 4 rounds of capital, just over $6 million. Started with friends and family, then went to institutionals and high net worth individuals. And then this latest round that we closed in December of 3 million was existing investors, venture capitalists, and family offices to high net worth individuals.
Awesome. Michael, you wanna go next?
I'm Michael Ott. I'm the CEO of Rantizo. We are a drone spraying company based in Iowa City. We have operations now in 18 states, so we're expanding pretty rapidly using drones to apply for agriculture. And our team just got our 15th employee starting today. We've raised just under 9 million in 3 rounds. Most recently closed a 7.5 million Series A led by Bayer and including Fall Line Capital, Lewis and Clark, and Innova as VC funds. ISA Ventures has participated. Sukup Manufacturing also, and a couple of strategic manufacturing partners in that as well. So both VCs and strategics in that last Series A round.
Awesome. I think that leaves Casey.
All right, glad to be here. And have I mentioned Roboflow's awesome, Brad? You've got a great product. So welcome everybody. It's good to have folks here. Casey Niemann, I'm the founder of AgriSync. We are the leading customer experience platform in the agriculture industry for support and communication, and we help connect in-customer farmers to the brands that they trust and know. And I will say up front, since my friend Michael and Kyle are on both kind of in this ag tech space, their technology works perfect all the time. But as an industry, we have some support and communication issues, and that's kind of where AgriSync comes into play. We did a convertible note and did some matching convertible note funds through IEDA early on. And then we did a seed round where Innova Ag Innovation Fund was our lead investor. We also had a few other high net worth investment groups that participated in our seed round. And again, that was a couple of years ago. We're a team of about 22 people based here in Des Moines, and we are a global service. So glad to be here.
Awesome. That's a pretty wide range of different funding sources from all of you. I think maybe if we could double click into that a little bit and dive into your most recent fundraising round. I saw Ben Milne had put out a post about like what he's been seeing working with different founders of kind of the process that they put together. And I found that pretty interesting. And I'm curious, what was the process for your most recent round? How did you meet those investors? How long did it take from beginning to end? Anything kind of interesting? If you were going to like go back in time and, give us the cliff notes of what was to come for that round. And we can maybe see the similarities and differences.
Yeah, with ours, we set out on trying to get 4 to 5 million in a Series A in 2019 and just didn't get the traction that we needed. So I ended up doing, I scheduled a conference in Silicon Valley that I had no real interest in going to, just knowing that good investors would be there. So I used that time to just meet up with half a dozen or so pretty good groups. And then we ended up getting 3 of those meetings led to eventual investors in our Series A round, which happened a little bit later. So the lesson that I would like to impart is like start early and make good connections way before you think you need it. That was actually probably early 2019. And then we closed, the end of 2020. So that it just takes a long time. And then like, as we were in it, like we had our lead locked up and like, for sure, we're going to close by Labor Day. And like guaranteed by Halloween, like no later than that. And then we close just before Thanksgiving. So that's how long things stretch out in the due diligence process, especially with like a corporate strategic. VCs are pretty detailed, but you get the full due diligence with corporate strategics.
So if I got that right, it was you met them beginning of 2019 and closed towards the end of 2020.
Yeah, I knew that I was going to be doing it. So I mean, I started just taking those meetings and putting that together. Yeah. So, and then like we didn't know a pandemic was going to hit, but we ended up, like I said earlier, only one investor came to see us through the course of the last year, and we, it was people that we hadn't met in person in a long time.
Yeah, from our side, we January of 2020, we at our board meeting, we identified we're going to start raising capital in March of 2020. As soon as the pandemic came around, we did whatever we could to delay expenses, delay anything possible to have to delay that investment conversation until at least the summer, hoping it was going to be better. And I think the scariest part had kind of brushed away by that point, and people were getting back to getting used to the normal of meeting people online and writing checks. That said, every round has always taken 6 months. It always feels like it's going to not take that long, especially off the get-go when you get verbal commits, and then you have to make sure you have your lead, and then closing multiple. If you have to close in multiple chunks at the back end, it's always a challenge, and it's always going to take longer than you think it is. But for us, it's always taken 6 months from an initial conversation internally of, all right, this is when we're going to start, to the last time the funding closes at the very end. So, we always think that each of the rounds, I've had the opportunity to do this 3 times. You'd think third time's a charm to get it right, but there's something different every time because you deal with different investors.
Did you run a particular process this time around, or it was just kind of ad hoc because of COVID?
Yeah, I'd say the things I've learned from the previous rounds. I would get introduced to somebody, go through the motions, the regular pitch and investment conversations. This time around, we did it differently. We got a Rolodex out. Fortunately, I had been using a CRM of all the investors that we'd been speaking with, laid all of those out, and in one week, hit as many of them as we possibly could. I mean, you're effectively selling a product as an auction for the highest price, right? So you need to have as much interest as you possibly can, in my opinion.
Yeah, I just echo Kyle's comments. I was fortunate, right? I knew a lot about the tech and the sales space, but I had a co-founder who knew a lot about raising capital and managing, kind of an investment process, and the ability to manage your pipeline of potential investors the same way you would customers, meaning use a CRM, figure out that funnel, to Kyle's point, and get intentional about how you're going to do that is super important, because you're in your mind, you're thinking, well, this Zoom meeting or this coffee meeting is going to be unique and I'll remember every detail, and then you do 50 of them and you don't. And so I would just encourage folks to, if you don't have a plan or a process or a CRM, have an intention to use one. Plus, if you go back, later and you need a follow-on round, you want to be able to pick that conversation right up where you left off. And the first thing the investor is going to do is say, well, what have you done since our last conversation, right? What milestones have you achieved before I consider writing another check? And, I think that is, just in terms of notes, make sure that you run it sort of in a process via CRM, because I think otherwise you're, and I think also for us, we try to keep tabs on those investors as well, and periodically just give them positive updates on the business, even if you're not raising, because sometimes it's good just to share out and say, hey, we know you're in the marketplace for investment. Here's our latest milestones, or here's our latest updates. And I think if you're, on the previous panel on the investors, they welcome those updates, right? They want to keep you on your radar, especially if you're hitting your milestones.
And I would say for us, I would agree with about at least 6 months. It always takes longer than you think it's going to close something. But I guess I have a little bit different strategy with raising because I haven't raised as much as these other companies. And for me, the way that I've raised in the past is by direct introductions from people. And that's how we've found most of our angel investors, and also the different groups, the angel groups that we've been pitching to. So, and I don't know is that something that you guys saw when you, like, if you go back in time for your companies, when you were raising some of those earlier rounds, is that what you did similarly, or did you always use a CRM for those conversations?
Yeah, I think about a month or two in, we decided we were going to put it all in a CRM. I think we also started to kind of categorize potential investors. And we would say, hey, this investor typically leads, right? So they're a lead investor. This investor is a follow-on, and we got very specific about saying, okay, this is a lead investor. They know agriculture. They have invested in deal sizes of our type before. So we'd sort of profile them and make sure that, number one, they were a right fit for where we're at. And we had some investors who said, hey, we're interested. We'd love to write a check. And we said, oh, your check is bigger than what we need right now as a seed investor. We're probably not a fit. And I would just say it's important to know that too, right? Because what you don't want to do is, maybe get over your skis in terms of what stage, if you're doing, again, a seed round or an A or a B. So we got really intentional about kind of categorizing those. And part of it was time. We would say, okay, do we want to be this investor's first investment in agriculture? Do we want to have to teach them about the cyclical up and down nature of our industry? If we're like the only one. And so that was a big deal for us. We didn't want to find people who, every time we would have a board meeting, we're first teaching them about our industry and then second teaching them about us. And so, now that doesn't mean that your investors all have to be in an industry, but, my read is people invest in what they understand. People invest in things that they can kind of get their head around. And most investors are pretty savvy across a wide array of industries. But, I would caution people, because you could spend a ton of time and cycles. If your goal is to get a lead and get your price established and all that good stuff, get that done first, right? And then kind of keep all of your follow-on investors, warm. Because as Kyle said, you're trying to get that first, investor to kind of establish your terms before you get others to follow on. So be thoughtful about maybe how you categorize the investors.
Yeah, absolutely. It's relatively easy, I think, to get introductions because people are generally willing to give those, like, oh, I know somebody there. But make sure that it's a valuable one, and you're right in terms of check size and scale and timing and everything else. Because I can talk to a lot of ag tech VCs that write $5 million checks, and I don't need that. Like that's an easy thing to find. And I think you can also find a bunch of angel investors that will write you a $25,000 get you started, but they don't really know anything about your industry or anything else like that. And you quickly spin your wheels a lot if you're not really thoughtful and dedicated about it. So I think those are excellent points.
Totally. And I think, different stages, there's kind of different strategies. And Casey called out, finding your lead. Oftentimes what I've been seeing in the earlier stages is there is no lead, and you just kind of raise on a series of safes or convertible notes, pick a cap and kind of go at it and do a rolling close, which has been kind of interesting to kind of compare and contrast those. I guess, so maybe dialing back now, we talked about your most recent fundraising round. I'm curious about like what your early rookie mistakes were of if you were advising, a new entrepreneur who's raising capital for the first time, not to make the same mistakes you did. Is there something that you can think of that was, particularly an own goal? And while you're thinking about that, I'll share ours. This is like fresh in my mind. So we just raised our seed round last fall coming out of Y Combinator. And I think in retrospect, the thing that we really screwed up was trying to actually be too creative. And so we structured the deal around this kind of premise that we wanted to do a priced round because we wanted to create an employee option pool that would dilute our safe holders and have everything convert. And additionally, like as an angel, I always like to know what I was buying, and I never liked these rounds that had like a questionable price that wasn't set until later. And so as an entrepreneur, I kind of wanted to do that same thing. And it turned out that we should probably be focusing on innovating on our product and the things that we're good at, not on the financials. And it turned out that we ended up paying over $100,000 in legal bills to get that round closed, and it took several months instead of several weeks. And it all worked out kind of the way that we expected it to. It just took a lot longer and was a huge distraction from what we should have actually been working on. And so that was kind of my lesson that I took away from that was like, focus on the things that we should be focusing on, and don't really worry about 1 to 2% of dilution, because if you make the company 10% or 50% more valuable, that's way more important.
I spent way too much time with an investor that didn't have any money. That was, I don't know, 6, 7 meetings, I think it was. And then I found out that they haven't put their fund together. They're trying to get an investment so that they can get their investment. So make sure the fund's legitimate and ask the question of how much money, how much dry powder do you have left in your fund?
Yeah, we did the same with a guy who he was going to lead it, and then he was just going to do 100,000, and then he agreed to do 25,000. And I was like, oh my God, we spent like 6, 7 meetings. This is insanity. And then we took fast money, like a big fast check that closed really, really well, easy. And it turned out to be a nightmare group to work with. Just completely unrealistic expectations, completely naive in terms of what they should be able to get, what they should be able to ask for, and everything from there. And it was helpful to have seasoned people around that, like, you're not crazy, these requests are insane, you shouldn't deal that. But it was a lot of time at a time where I didn't have extra cycles to give.
Yeah, I think if you're starting out and you're kind of at a blank page and you're participating in this webinar today, and somebody calls you up and says, hey, I'd like to talk to you about investing in your company, you're all excited, right? You want to be wanted. Know that it's, again, a two-way exchange of value. And you might also be picking your board member, your future boss. And so be selective about that. There's, I think we're fortunate here in Iowa. If you think about some of the investors we have and other people, they're invested in our community, right? They're not just sort of trying to, yes, they want to return, but they also want to build our ecosystem. And to try to figure out, like, what type of organization is going to help us beyond the check? What are they going to bring to the value add? So if you're sitting in a board meeting with them a year or two later and you've got a really pivotal decision to make, do you have a good balance of, investors that are on your board? And, what's their past experience been? Have they run companies before? Do they have some industry knowledge? Do they have patience when things are not going well? I guess just especially on those early ones, it was brought up earlier about kind of keeping things simple and making sure you don't get a bunch of stuff in your cap table that later makes you non-investable, if that's a term or a word. But essentially, you don't want to scare off, future investors for future rounds because you cut corners or did something complicated. And, I remember, when we think about sitting down with Brown Winnick, who helped us with kind of putting together our governance, and the coaching was just, keep it simple, and don't do anything here that wouldn't allow you to be, a good investment in subsequent rounds. And this notion of kind of having a clean cap table and you being somewhat selective about who you take checks from is a big deal. You don't want to be the founder who dreads going to a board meeting because you feel like you've got the wrong, board member. And so be really thoughtful about that.
Mm-hmm. Yeah, there'd have to be a really good reason not to use a standard NVCA document. Like I have a hard time thinking of why you would really want to do that. And it just because that solves things later down the road. I've talked to many people like, well, we did this thing early on, and now it was fine for us in the beginning, but now it means that our pricing is off, or now it means that we've got an extra 13 people on our cap table that each have, 0.65% of a share or whatever. And like, that was an easy thing to do in the first 2 months that, holy cow, that becomes expensive later on. So keep it simple. It's a really good lesson.
Hey, Michael, can you, for those of us that need to know that acronym, what's NVCA?
Oh, National Venture Capital Association. There's standard a cap table that you can just enter in. It's super slick and easy. You're just like, okay, at our founding round, this is how we had it. Our Series A was priced at this, and then everyone converts. Series B is that, and it just all flows through, and it takes you like a half hour when it could take you 2 months to do that.
Cool. I haven't heard of that as a
Yeah,
resource.
don't let somebody convince you to put together an entire PPM as a pre-seed stage company. I come from the private equity world, so I asked somebody, hey, we need to create investment docs like a PPM or something, or whatever early stage companies do. And he literally came to me, the attorney that we're considering, with a $25,000 PPM private placement memorandum document that is totally unneeded. Go NVCA route all the time.
Yeah.
I think it can be helpful if you have a simple subscription agreement and a simplified term sheet and a cap table I still have my cap table in an Excel document and it works. It's simple. We keep track of every round. The other thing, I guess, kind of springboarding off of what Casey said, but just make sure that you find investors that you want to work with, that you can communicate easily with and be transparent with, because hopefully you're in it for the long haul, not just like it's great if you have a quick exit, but you still want to create a sustainable company and business where you're really servicing your customers. So find people that can really help you set your company up for success to service those clients.
I would also say, if you're listening to this and you're like, gosh, this sounds complicated, these folks have gone through a bunch. I can speak for myself, and I think probably Lana, right? We're more about the technology in our companies. It's a little unique in the fact that Michael, Kyle, and Brad, I think they've been on both sides of the table of investment. So lean on people like that, right, in the community, because those are rare. And I know, like Sheldon, who was on one of the earlier panels, right? He's been both a founder of a company and an investor. And I think is the blog post, Both Sides of the Table, is another good one to kind of check into if you don't have that background. But there's some folks here on the panel who have been both investors as well as founders, and that's kind of a really unique and rare thing. So they probably have more of the savviness on some of these topics, relative to myself.
I think a couple of you now have touched on kind of the value that your investors can bring to the table. And I think there's like this spectrum that I've heard of, on the one side, there's the people who say most investors add negative value. And so if you can just get one that brings money and stays out of the way, you're doing better than most. And then on the other side, it's like, your investor is going to be a partner forever. Pick somebody who can really add value. Curious where you all fall on that spectrum, and if there's any ways that investors have been surprisingly helpful, or anything about how to utilize your investors to get more value beyond just the cash.
So we had a couple options for lead in our round and chose the corporate strategic for a few good reasons. The ability to leverage what they've already got in terms of regulatory formulations, publicity, et cetera, et cetera. It's hard to put a number on that. Like, I just did a panel with their chief scientific officer and 600 global journalists. So how much is that worth? I don't know, but it's a lot. Those things really add a lot of value, and working with people who get it. We've also got another group that owns quite a bit of farmland, and then we can test things out on that land. So finding those extra things that you can, and I agree also, you do want to have, there's certain times where you want money that just is money to be on the side. Like I think in a seed round, you know, a rich lawyer or a rich dentist is great for $150,000 and quiet. Like if you can do that, that's awesome. But when your dentist is advising you on the best thing in ed tech that they read in the Wall Street Journal, then you need to reevaluate that.
I would also say there's value in kind of what I'd call neutral money early. Okay. If you're building out a net new company and, you know, out of the gate, you have one strategic that wants to put a lot of money into you, know that they're essentially buying you before they bought you. And the ability for you to attract their competitor as a customer may become limited. And, you know, keep in mind, if you're at a big, you know, corporate strategic, that's a great thing, you know, to get those, but make sure that's where you're at in that chapter, because I know that we put a heavy emphasis on kind of what we call neutral investment that wouldn't cause us to not get a customer later on down the road. Because definitely larger organizations, and part of this might depend a little bit on, you know, who is your customer. You know, in our case, those big platform companies, they really matter to us. And, you know, us not having one of them own us is helpful when we would like to have revenues from all of them. And so, you know, be a little bit thoughtful about, you know, is the investment I'm taking going to prevent me later on from any commercial, you know, relationship with an organization?
Yeah, from our perspective, there's from a overall board perspective, as we look at investors, obviously you're going to be building a board. There's 4 key components that were important to us to continue rounding out our skill sets. Number 1 was finding somebody who's really good at sales and has been successful at that and is an investor. Number 2 is data, then technology, then agriculture. Not every investor has to know exactly what you do, but if you can round out that skill set or those skill sets on a board or investors that you can reach out for mentorship and advice, I think that's been really key for us to be able to leverage investors to help make an impact. The other thing I'd mention on this topic, Brad, for sure is don't forget about, like, if you're really early stage, don't forget about the other benefits that are now popping up all over the place. Like shout out to ISA Ventures. They've got a list of, like, I don't know, 200 different software packages that you can go take advantage of. You know, like $100,000 Amazon AWS credit, things like that are very important and are non-dilutive.
It's interesting. I wonder, so for you guys here on the panel, how many of you, it's your second or third company that you started?
First.
Okay. I was just curious if it changed the type of investors that you tried to gather early on versus later on. Because initially when I started with Clinic Note, I needed investors with those different skill sets that were willing to be active and teach me the things that I didn't know, because I was just like a sponge. I just needed to absorb as much knowledge as quickly as possible. And so it was key for me to have that and have more active investors. But I wonder how that would change if I do another company in however many years.
I mean, at least for us, our angel investors have been some of our most helpful investors. Like oftentimes somebody who only put in $5,000 or $10,000 into the company is just as engaged and helpful as the lead investors that put in $1 million each. And one surprising way that we've been able to leverage them is in recruiting. If they're like, we have some investors who, like, one of them was an early employee at Stripe, and his options were, should I go work for Stripe or should I start my own startup? And having him talk to a prospect that we're trying to hire about why he went to go work for Stripe versus starting his own company, and how that now led him on this pathway to becoming very successful, has been really helpful for us in recruiting people who are making that exact same choice right now. And then, of course, we're like the people with that domain expertise. It's just amazing to be able to talk to people who have been there in the trenches before and done things.
Yeah, I think it's important to acknowledge what you don't know. And a lot of times people have a hard time doing that. So if you can just say like me, I don't know anything about coding. Like I'm hopeless and worthless. I can't even get started. I don't know anything about it. So if you just say, I don't know anything about this, find somebody you know and trust that can do it and run with it and take it from there. That's really good. And I think investors are good about that too. Like, hey, I've never licensed the technology from a university. How do I get started with that? Then like, okay, well, here's someone that you can talk to or whatever the need is, but just be, I like being open with those things.
So I'm going to take a question from the chat next. This might be a little unorthodox, but I'm going to scroll back. This was actually a question that Kyle asked in the first investor panel that didn't get talked about. But Kyle, you asked about recruiting talent to Iowa and what we could do. And I think my question for you is like actually twofold back, and for all of you is, how important is that in this day and age of being all working remotely? Are you all building fully distributed teams now, or are your employees still coming here and you're anticipating going back into the office? And kind of how has your philosophy around remote work changed or not changed, and especially around recruiting?
Yeah, that's a great question. COVID has taught me a lot that remote work is okay. I've always been the person that have to work in the office. I don't want to hire somebody from Silicon Valley where they're working there and we're working here. I think it's just the Midwestern hardworking person that I am, and I want to see other people working alongside of me. But COVID has really changed my opinion on that, and we're 17 full-time employees now, and 2 are completely remote. Our engineering team is still remote here in the Des Moines metro area, and we do a lot of paired programming, and so it's still we're able to work very well together being remote. So that's definitely changed my opinion on that. But I still think as COVID goes away, I think that, we've already seen it. We've had people get COVID in our office, and they have been back in the office and have to leave. They are after their second time having to stay home for 10 to 14 days, they're very antsy to get back to the office. So I think that'll still be a critical component to at least our company long term. So I still think hiring engineering talent in the state of Iowa is going to be needed. I've asked Kim Reynolds this several times of how do we continue building out this pipeline of better technology in the state of Iowa. There's been some really good exits, especially in agriculture, and you're starting to see this, I think, a tech ecosystem really start to get humming based on a lot of people on this conversation today. I still think it'll be a critical component to continue building that out and learning from other regions that have been successful. So I don't have any crystal balls, but there's a lot of people on here that have thought a lot about this, and I always like to bring up this question because I think it's important for all of us to be able to hire and continue to expand. We can raise capital, but can we fill the seats that we need to fill?
Yeah, how do we also maintain? Sorry, how do we maintain? How do we maintain? I think the question for you as a founder is how do you maintain and build culture in a remote or a hybrid environment? And that's, I don't know that there's a perfect answer, but I think there's a challenge there for all of us to say, what are we going to do to, maintain culture, but also recognize that the workforce is changing. And to Kyle's point, there's certain engineering talent that we are always going to be short on in Des Moines, Iowa. There are other types of roles where, we're fortunate to have, a great pipeline of bright ag students that want to come out and work in our industry. So for us, we're a mix, we're a hybrid. We don't think that there's one way or another that's going to be an absolute, but we do know we want to grow. And I think for all of us that are trying to build businesses in the Midwest, this is our opportunity to go to those folks on the coast and say, stop paying $3,000-$4,000 a month to work out of your apartment, right? Pack it up, move to Iowa, join a startup. Those are opportunities for us to bring talent here, probably give them a better lifestyle, an opportunity to innovate. And, obviously we all want an influx of talent coming in. So, my hope is post-pandemic that Iowa and other places are net, beneficial, right? We attract more people here, but I think we've got to be intentional about that. We've got to open our doors and maybe start, being a lot more open to remote work and different things. But over time, our hope is that we try to get more of that talent here. So, Michael?
Yeah, very similar thoughts. Like there's certain roles where remote works very, very well. Like our software people that we're bringing in, that's a lot can be done remote. It's good for them to see what you're doing. And I agree with you completely. I was going to talk about culture because when you're remote, everyone's working from home. You don't get the laughs that we have here in the office. You don't get the inside jokes, and then it kind of splits people off a little bit. So the culture thing is really, really important. So maybe more focused efforts on that, or after work things that you can do for fun. That's really important. But I'm also old school like Kyle, where I want to be in the office and I want to see most people in the office most of the time. When we're doing hardware things and moving stuff, you have to have that, but there's certain things that can be done fairly well remotely. And then we've found we're super flexible on, you've got a sick kid, you can't get your kid because their school is shut down or whatever it is. Like we're really, really flexible with that. And we've been dedicated in our hiring process to find people that do that and make it work. And sometimes I get emails at 9:30 p.m. because like, yeah, my kid was sick all day, but I had to get this done, and that's great. That's fine. And we're supportive of that.
And I would say for us, we probably won't ever go back to an office. I mean, I shouldn't say ever, but we like using Slack. We like using Airtable for productivity management and seeing what everyone's working on at a glance. That's been really key in our weekly team meetings, bi-weekly, more deep dive meetings with each person. But I've never really been one to just want to meet. So it's really nice that people can actually get their work done. We have one employee that we hired. I've met him twice in person. And so it's just interesting learning the personality of people as you hire them and you are fully remote. I think something that I'm excited to do again once COVID, I don't know what happens with COVID, but once we go back to whatever normal is, to do team retreats, because I think that's a cool opportunity to build some of that camaraderie, but also making a point like at the beginning of meetings to ask about people's lives and not just go straight into work is really important. And recognizing that they do have their own family lives and things going on behind the scenes, and making sure to make a point to recognize that and treat them, as people, not just robots.
Yeah, I think that makes a lot of sense. I think for us too, there's not going to be any going back, because we kind of started hiring people in the middle of the pandemic, and I mean, it's half of our team is outside of Iowa now, and I think it would be not particularly fair to ask them once the pandemic's over to move here. So we'll have to figure out how to make it work. But I think that's kind of the new normal, and it's actually exciting to be able to work with the best talent that you can find, anywhere that it is. Kind of to pivot that back towards the investment talk, are your investors kind of local to Iowa? Are there any that you haven't met? Any differences between the ones that you have and haven't, that sort of thing?
Prior to this latest fundraise that we completed in December, just 3 months ago, I had met every investor, but in this latest round, I didn't meet a single new investor, just over Zoom. It was all done virtually and was pretty successful. Very efficient, but I also think that efficiency lies in the investor hands. They can do as many meetings as they want, so they have the option of being more picky to put their capital to work.
Yeah, same here. I had met everyone on our cap table before, but I only saw one of them personally during the fundraising.
Yeah, we didn't raise during the pandemic, but I do try to keep tabs, if you will, with our existing and potentially future investors. But I do think trying to build relationship, and we've all learned how to do that, virtually. I would just say if you are doing, anything virtually with your business, come in, with really clear objectives, and it almost forces all of us, both sides, the founder and the investor, to communicate very clearly about what are your objectives, right? What is it that you're wanting to do with the capital? What are your metrics? Be super crisp. I think it was brought up earlier about how they're starting to see more startups, come with really planned out intentions of, their war rooms, et cetera. The bars continues to get raised. I listen to some of these virtual pitches, and I'm just blown away by the talent that we have in some of these kind of competitive pitch sessions. And I think, wow, I'm glad I wasn't competing against that guy for a pitch session or whatnot. But so be ready. And I think, I also feel like here in our community, don't be afraid to ask other people for coaching and advice on where to start. And the key is to start. You're not going to get the first few sessions you do, whether it be virtual or in person, they're not going to go perfectly, right? But not starting isn't really an option. So
I knew most of my investors, but for this round, there are a couple that I haven't met in person, but luckily there's mutual connections that overlap, so it feels a little bit more personal rather than just like meeting someone that's completely a cold market lead, which I kind of recommend in general for investments if you can figure that out, because it just feels more comfortable. The trust is easier to be built quicker.
I thought it was interesting. One of our lead investors sent us a term sheet and then said, hey, you want to come over and to my house and talk about this tonight, just assuming that we were in the Bay Area. And I mean, they hadn't asked where we were, we hadn't volunteered it. And so that was the first time that he learned that we were in Iowa. I think that's kind of like an advantage that we have now, is that, if investors assume that you're in the Bay Area and, valuations and prices are higher there, you can kind of arbitrage that sort of difference and pay Iowa prices, but raise at coastal valuations. It's kind of the best of both worlds.
You could have said, Brad, they could come to your house, right? Because you've got your whole crew right there. So
Yep. So one question that came up in the chat is, and I think this was inspired by Jeff Wood's recent post about some stuff that's been going on in the Iowa legislature and how that kind of affects recruiting and retention of employees. And I was wondering if you all have any thoughts around how politics play into startups and whether it matters or not. Kind of any thoughts on that regard?
Yeah, it definitely matters. You have to be cognizant of what's going on in the market and in the industry and the world, and you have to adopt that internally as a company.
Yeah, it's competitive enough already. We as a state need to be competitive in everything that we do. And, again, if we think about trying to get talent to come into our state, we need to be open, inclusive, and welcoming, of a diverse talent pool. And, I think all of us obviously see that, talent is probably the biggest fuel, right, to our business. And so, as an entrepreneur, I think we want to be encouraging of anything we can do from a public policy perspective to make Iowa a great place to move, live.
Yeah, don't shoot yourself in the foot. There's many people are trying to shoot themselves in the foot. So I don't want that. It's hard enough. We're all running races. You don't want to do it.
Yeah, I think at least from our perspective, hiring remotely, it definitely affects whether people want to move here. But since we're not asking them to, I think they can kind of opt to live where they want to. And I guess from my perspective, I certainly don't agree with everything that goes on, but part of a democracy is that we can all participate in that process. And so I think people choose where they want to live, and it's kind of a free market of ideas. Lana, did you have anything that you wanted to add to that? Otherwise, there's another question here in the chat.
I mean, not really. It's good to speak up for what you think is necessary. I haven't necessarily gone up to the Capitol building to talk about our needs as a startup here in Iowa, which, I mean, I think gaining a little bit more experience then fuels that a little bit more, which maybe you guys have a little bit more to add on that, but I have had opportunity to mention like some things with like the state funds that I think that could be improved for some of like the rules that they have. But other than that, I just try to only speak on things that I've had experience with.
Sense. The next question in the chat's from Michaela Sullivan, who recently joined at ISA Ventures. She asks if there's been any major pain points working with investors, and what can investors do to make the investment process and due diligence process less painful for entrepreneurs?
I think entrepreneurs need to be organized to make it less painful. I think it always comes back to the entrepreneur and have an organized data room from that perspective. I need to keep thinking on that one for further answering.
Yeah, I don't like the, hey, just fill out this form every month with these metrics that we need to have. That's so annoying, and everyone has a slightly different form that is like, one group cares about, you know, this segment of customer revenues, another one really has to know the change in ownership by minorities, and there's so many different things that you get to be formed to death that makes it hard.
I would just say understanding mutual timelines, right? And making sure that your investor and yourself are on the same wavelength when it comes to timelines, because, you know, I think somebody mentioned earlier, you know, where is that investor at in terms of their fund and fund deployment and all of those things? Those are, you know, good questions. If you're listening and you're a founder, make sure you know the 4 or 5 questions there that you should ask them to kind of qualify where they're at. But, you know, I think most good investors are very transparent of where they're at in their fund and their deployment and how they feel about follow-on investment. You know, those are really good sort of those qualifying checkpoints that you want to have when you go talk to them.
I think part of that, setting expectations initially when you're raising the money, setting expectations after you've raised the money of, okay, how often are we going to communicate about this? What do you need from me so that you feel comfortable with how everything's moving along? And like I have some investors who I meet with monthly, and some investors who I give them the quarterly update, and sometimes they reply. So it kind of, I mean, it's important that you as the entrepreneur know exactly what your different investors or investor groups want from you, and then clearly communicate to that level. Or if it's too much, then communicate or work together to try to figure out how you can make that mutually agreeable.
Yeah, I think that makes sense. For us, I mean, we had a pretty easy fundraising process, so I don't have a lot to complain about. But the one thing that was frustrating was VC firms that didn't have a clear conflict of interest policy. And so we had some conversations where we'd get into it, and then like either the VC wouldn't even know what to do if there was like a competing company already in the portfolio. They wouldn't know what constituted a competing company, because like, you know, our vision is pretty big. If we get to be the size of Google, we're going to compete with half their portfolio companies. So like, where is the line? And then it, you know, how do you go about that? And there were some firms that were really good about, you know, double opt-in. We'll introduce you to the other CEO. You guys both hash it out and figure out, is there a conflict, and you both have to opt in. And there were other ones that it was just kind of the Wild West, and it wasted a lot of time, where we got to the point with one firm where it was like, they were going to give us a term sheet essentially the next day. And then they were like, oh, I got to ask these other 2 or 3 portfolio founders. And it turned out that they weren't able to follow through on that. So it would have been nice if that we had known that at the beginning and wouldn't have to spend a bunch of meetings on it. But
yeah, I think setting expectations up front is super critical. And I've learned that the hard way. There's an investor that said, hey, we can bring all this value. We can make all of these introductions because, you know, they're our LP base or something along those lines. And then those introductions don't happen because they're too scared to go make those introductions. That's what's been very frustrating to me, just from an investor standpoint. It's a little bit off the question, but I'd say make sure there's clear expectations and understanding how, if the investor wants to help or the entrepreneur wants the investor to help, how they can actually do that.
Cool. Well, I think we're about running out of time. Appreciate all of you joining on this panel. This was a lot of fun. Have a good one. I'm not sure if Chris is going to come back on and close this out or what, but I enjoyed it. Hope you all did too.
I will.
Yeah,
I'll take about a minute. Not very long. Amazing. What a great. Both panels were great. The information is amazing. I think that everybody got a tremendous amount of value out of this. This will be available. I do not have the information on how you'll be able to access it online, but it'll be recorded. Thank you to all of our participants, all of our panelists, our moderators, everyone who participated in planning this. I think it was an incredible event. So great job. Thank you, everyone, very much.